battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name's Nick Stenger. We are Stenger Family Office for the past 44 years. You'll remember it's been our family's mission to deliver both clarity and confidence to help secure your financial future. It is episode 209, and it is, in fact, the last episode of 2025. It is week 52, if you can believe it. Absolutely incredible how fast this year has flown by. And then next year's episode will be actually the first of 2026. Just incredible. We had our episode 200 special earlier this year. And you'll remember we started this thing back in 2020 during COVID and just never stopped. So about 6 years now in the making of putting this show together and staying on top of all the news that's coming out, all the doom and gloom, and trying to give you the clarity and confidence, the reasons why you have to stay on your plan. And like I told you last week, we are combining two episodes this year. We're going to do the Christmas show today, plus our market outlook for 2026. So don't go away. We're going to be getting into it here in just 1 second. Before we do, I do want to remind you about October 8th and 9th. That's Investor Day next year. You cannot miss that thing up here in Chicago. You've been thinking about coming into it for the past few years now and just haven't been able to make it. Well, this is your chance to get it on the calendar way before it gets full like it does every year. We have the legendary Tom Lee, who is going to be headlining Investor Day next year. You cannot miss this thing, October 8th and 9th. Get it on your calendar now. Don't forget. So before we jump into the actual outlook for 2026, I do want to do our usual traditional reading of the Christmas story, and we'll jump right into it here today. Luke 2, and this is the Christmas story. Luke 2, starting in verse 1. And it came to pass in those days that a decree went out from Caesar Augustus that all the world should be registered. This census first took place when Quirinius was governing Syria. So all went to be registered, everyone to his own city. Joseph went up from Galilee out the city of Nazareth into Judea to the city of David, which is called Bethlehem, because he was of the house and lineage of David, to be registered with Mary, his betrothed wife, who was with child. And it was that while they were there, the days were completed for her to be delivered. And she brought forth her firstborn son and wrapped him in swaddling cloth and laid him in a manger, because there was no room for them in the inn. Now, there were in the same country shepherds living out in their fields, keeping watch over their flock by night. And behold, an angel of the Lord stood before them, and the glory of the Lord shone around them, and they were greatly afraid. Then the angel said to them, "Do not be afraid, for behold, I bring you good tidings of great joy, which will be to all people. For there is born to you this day in the city of David a Savior, who is Christ the Lord. And this will be the sign to you. You will find a babe wrapped in a swaddling cloth, lying in a manger." And suddenly there was with an angel a multitude of the heavenly hosts praising God, saying, "Glory to God in the highest, and on earth peace, goodwill toward men." Wow, what an absolute incredible reminder of what Christmas is really about. And what we are trying to do at Stenger Family Office is remind you of those things. And with all the fear going on in the world, with all the panic, with all the chaos, and in a time where it seems like the future is so uncertain, that is the guiding light. And in the Bible, it says literally hundreds of times, do not be afraid. That's the whole message of the Christmas story, peace on earth, and to remember that we do not have to be afraid about the future. So that's what we also want to do here at Stenger Family Office, is just remind you of that. And I hope that you are able to think about that a little bit throughout this season. So let's jump into it and get into our 2026 market outlook for next year and where we think things are headed. But to do that, we have oftentimes taken a bigger approach or a bird's eye view of the past couple years. And it's hard to believe, but here we are today, and we are almost 6 years out from the original COVID fallout that we had in March of 2020. So here we are 6 years later in the aftermath of COVID. And you'll remember in 2020, in just a few weeks, about 2 or 3 weeks, the market dropped 35% overnight. And all of a sudden, by the end of the year, market came roaring back, and we finished 2020, if you can believe it, up 18.5% in the stock market. Incredible. We did it again in 2021. Now, we did have some small pullbacks in 2021, but nothing like a COVID, obviously. The economy was returning to normal. Everything was reopening. And all of a sudden, we saw this massive, massive rebound, about 29% in gains on the S&P in 2021. In 2022, a lot of people forgot this, but we actually had a decline because of the Federal Reserve increase in interest rates. And in 2022, the drawdown at the worst point was 25%. A lot of people don't remember this anymore, but that is what happened. The Fed started raising rates in December of 21. They were late to the game, in our opinion. And by 2022, the market priced in a drop in profitability on the S&P, which actually never really happened. I think instead what was happening was we were pricing in what was going to be an economic recession. And nobody really called it that. Nobody said that it was a recession, but it's very important that you understand in 2022 that we did technically have a recession, 2 declining quarters of real GDP back to back. And the S&P finished the year not down 25%, thankfully, but down 18%, a pretty significant drop. That was a recession that a lot of people, including the experts, did not actually call a recession. Why is that important? Well, we're going to get into it, but let's cover 2023 for a second, because a lot of people were looking for this recession that actually happened in 2022. They were looking for it in 23 and then in 2024, but we had incredible, incredible years. 23, we were up 26%. 2024, we were up almost 25% in the S&P, back to back, just absolutely face ripper, melt your face off years. Now, 2025 rolls around, and we still have not had the economic recession that a lot of people had been calling for, unless you counted the 2022 like we did at Stenger Family Office. So we had Liberation Day back in April, and the market did drop 19% at its worst point. It's all in the rearview mirror now, even though it wasn't that long ago. And today, we're now sitting at a 17.5% return for the S&P in 2025. Obviously, a little bit of time left here to see what happens with markets the rest of the year, but very, very strong results. Even if we ended the year up 15%, that would be an incredible year. But I think we are going to be closer to that 17, 18% zone when it's all said and done. So my point to you, though, is if you were looking for this recession to happen, I believe it already happened in 2022. And because we've already gotten past this recession, very important to keep an eye on this. I had said to you on the show, I didn't think we were going to fall into another recession in 23, 24, 25, but because we had already had one. And that follows a very, very typical economic calendar or cycle. And so because of the fact that we already had this major pullback in 2022, we said the market was set to have a couple of really good years, and that's exactly what's happened. Now, one of the things we've been tracking to keep you one step ahead of the rest of the market, and we like to tell you we want to give you tomorrow's news today at Stenger Family Office. How do we do that? Well, one of the ways is we pull up M2 money supply. M2 dictates a lot of what happens in the economy. It's going to be very important as we go through the next couple of slides that you watch M2. We watch it very closely, and we also watch the velocity of M2. That's how much new money is getting printed into the economy. Now, you saw pretty slow growth in M2, not slow necessarily, but maybe just regular normalized M2 growth, you could call it, from the fallout of 08 and 09 all the way through pre-COVID, which would have been right before March of 2020. And so that line is very, very steady and slow moving all the way through 2016, 2017, 2018, 2019. You can see it on the chart there. But then what you see during COVID is this massive tick up in M2 money supply. So what did we do during COVID? Not only did we shut down the global economy, but to combat what we thought was going to be this massive recession, we pumped trillions of dollars of stimulus into the economy, and we literally printed the money out of thin air. That's what happened with M2. That's why you see that major spike. Now, M2 operates on a lag with inflation. inflation usually does catch up with them too, not 100%, but a lot of it does. But it takes a little bit of time to digest. And so if you were following what the Fed was saying during 2020 and 2021, is they were using this word transitory. They were saying that we were going to have inflation here today, gone tomorrow, and basically saying that all of inflation was due to supply chain shocks as opposed to actual money printing. Well, if you were following us, if you were following all the people that we follow who go back to the Milton Friedman era, they say that no, inflation is always and everywhere a monetary phenomenon. And like Milton Friedman taught us, inflation is simply too many dollars chasing too few goods. So when you saw this about 40% increase and spike in M2 money supply, you should have started thinking, we are eventually going to have inflation. It's not going to be transitory like the Fed is saying. And that's exactly what happened. We started to see this slow creep up with inflation, and then all of a sudden it skyrocketed. Inflation at the worst point almost hit double digits. There were some quarters where we printed 7, 8, 9, almost 10% annualized inflation growth. And that is significant. It's not the first time we've ever had inflation like that. It's not the worst inflation we've ever had, but it was a significant increase in inflation that we're still feeling today. Now, the rate of inflation is slowing, which doesn't make anyone feel any better, because when you go to Costco, everything still costs about 40% more today than it did 4 or 5 years ago. As Brian Westbury at First Trust would put it, actually your dollar buys less stuff at Costco today than it did 5 years ago, rather than stuff is more expensive. That's really the correct way to think about inflation. But inflation is still going up. It's just going up at a more normalized pace, not these 6, 7, 8% annualized increases like we had in the aftermath of COVID. So what did you do with your bond portfolio? If you were smart, right after you saw this big M2 increase, you went dramatically short term. Why? Because you knew the Fed was going to have to raise interest rates to battle high inflation. They were late to the party. They didn't do it on time. Remember, we were basically 0% still all throughout 2021. All we had to do is raise to maybe 1, 2, even 3%, would have slowed down a lot of the housing runaway, a lot of the inflation runaway, and we just didn't do it. So with your bond portfolio during 21, 22, you should have been short term. That's what we did at Stenger Family Office. We said, don't risk your safe money. And the 20-year Treasury, the 30-year Treasury got absolutely demolished. In fact, still not back to break even pre-COVID, if you can believe that. Now, you're going to see on this chart, as you go over to 2021, 2022, you still saw this massive increase in inflation. And that's what I call throwing gas on the fire. So what President Trump did during COVID was not a great thing from an economic standpoint. And we have hammered this home. We've tried to call it balls and strikes as we see it. And we've tried to tell you what we thought Trump did well, what we thought Biden did well, and we tried to tell you what we thought they didn't do well. Well, one of the things that Trump should not have done is pumped all that stimulus in the economy. With that being said, one caveat that I'll put on there is we just didn't know what to do during COVID at all. It was unprecedented. That was the big word everybody was using. It was unprecedented. And because it was unprecedented, we did unprecedented things. So you might have said, okay, well, we can forgive the actions that we took during 2020 because we just didn't know what we were doing. But by the time, and by the way, I still disagree with everything we did and to the extent we did it. But if you're going to make an argument, you could have made it in 2020 for all the money printing. Now, you fast forward to 21, 22, there was no excuse for throwing more gas on the fire of inflation 21 and 22. So while we might have already digested the 2020 madness, we are still living through and adjusting to the 2022 and the 2023 printing that went into effect. Now, what's really interesting, and this is why a lot of economists thought we were going to go into recession, is Milton Friedman said when you increase M2 money supply, inflation goes up. And a lot of people, Friedman never got to it, but a lot of people assumed that when you decrease M2 money supply, then you were going to have an economic recession. That just didn't happen. Although you did see this decrease in M2 money supply in 2020, late 2022 and early 23. So I think in fact, what happened was the recession that people were looking for in 23 and 24 was actually this stealth recession, like I mentioned in 2022. So they were looking for this cycle to continue to bottom as M2 went down. You see on the chart here, M2 basically bottomed in 2023 and even decreased into 2024. But then what they missed was that M2 started going back up. And now I'm going to just say on top of all of this that we don't like the fact that we're printing all this M2. I have disagreed with the Trump administration on that. I've disagreed with the Biden administration on how much money we printed. But the reality is if you believe that we're going to go into another recession because M2 is decreasing, you can just see it in the data here. We're not having that major decrease in M2 anymore like we thought we were going to continue to have. So that's why, in part, it's not that the Fed completely supports the economy, especially not in the long term, but that's why, in part, in the short run, we've had such a positive stock market because we've continued to keep up with the supply of M2. And it's also why the bottom hasn't fallen out for the U.S. economy. So all that to say, I think this trend is going to continue as we get into next year and as we get into the next couple years. But if you look at the year by year, play by play since 1959 of M2 and how it impacts inflation, we went back and did the math on this. And since 1959 now, M2 money supply is up 6.8% per year. That's annualized increase in money supply since 1959. Now, you might expect that during the Nixon era, where we got rid of the gold standard, that inflation would have increased even faster after we removed the gold standard. What I want to show you here is actually the opposite. M2 between 1959 and 1971, before we got rid of the gold standard, M2 went up 6.9% per year. But if you look at after 1971, so this is pre and post removing the gold standard, we actually had a slight reduction in the pace of M2 money supply since 1971. What I think this shows you is that we've always had a problem with the big Fed, even despite the fact that we had a removal of the gold standard in 1971. What happened way before this was when FDR said that you could not have private ownership of gold. And that, to me, was the real removal of the gold standard. So inflation was almost non-existent until the Fed was created. But after the Fed was created, that's when inflation really took off. It wasn't this factor of Nixon getting us off the gold standard completely and all the rest of it that shot CPI through the roof. It was actually the creation of the Fed in the first place. And when the Fed was created, they basically set out to say, we're going to have an inflation target of 2 or 3% a year. And they do that through a variety of factors. But the biggest question is, why have an inflation target at all? Well, it increases the amount of dollars that banks have as reserves that banks have to lend out. And that's essentially my belief on why the Fed was created in the first place. And you look at banks. Banks have never been bigger. Banks have never been more successful. JP Morgan is printing record earnings per share growth through all of this money printing. And we predicted that at the beginning of COVID. We said big banks are going to get bigger. There's an article, there's a podcast all about it that you could go back and listen to if you're interested. But we talked about this early on, that the bigger and bigger the Fed gets and the bigger and bigger government gets, these two entities work hand in hand. A big Fed loves a big government, and a big government loves a big Fed, and the banks are the ones who benefit from all of this at the end of the day. So it really had little to do about what happened in 1971, and it goes really back to the FDR era. Now, what's really interesting is you might expect that M2 would be up, or rather that CPI, inflation, would be up at the same pace as M2, and that's just not the case. CPI inflation, this is consumer inflation, is only up 3.7% per year. And I say only relative to 6.8% M2 money supply growth. That's why I say M2 money supply growth does lead to inflation, but not dollar for dollar. Here's what's really interesting. You'd say, what's my best hedge against that inflation? Well, look at gold. Gold is up 8.9% per year since 1971. But look at the S&P 500. The S&P 500 is up actually more than gold. It's been the absolute best asset class. Why is that? Why have we told you stay in equities for the long run? The reason is simply because companies management teams, equities have the ability to raise their prices to beat inflation. So why is it that equities go up more than 6.8% per year? Why is it that they certainly go up more than inflation at 3.7% per year? It's simply because of the technology, the innovation factor, as we call it. It's because companies are innovating faster than inflation can keep up. So really, the way I think about technology is literally a miracle from above. Technology is the saving grace of any economy. It's the saving grace, certainly, of the U.S. economy, that we are able to innovate faster than the cost of goods going up. That is absolutely a miracle. It's incredible. The fact that we are finding new technologies every day and every year, and technology is moving so quickly, and high-speed computing and cloud and AI and everything else that we have today is a function of ideas. It's a function of entrepreneurs creating new businesses. Now, all the business creation, all the business formation, all the innovation, for the most part, has happened right on U.S. soil, and it's been done by people from all over the world. All the smartest Chinese, all the smartest Japanese, all the smartest Europeans and the Germans and the people from Latin America and Africa, everybody who has a business idea, who wants to be able to pass down their life's work according to their wishes, is right here on our soil. So the saving grace of the U.S. economy in the long run is entrepreneurs, not government, not the Federal Reserve. So what I want you to really pay attention to as we get into next year and the years after is this balancing act between Federal Reserve and government action versus entrepreneur action in the long run. So as we get into the next couple of slides here, you're going to see this is going to be very apparent that there's this equation we've used to value the stock market, and it's why we've said that stocks can continue going up over the long run. Earnings E in the PE ratio is what companies drive over time. Companies and management teams have influence to an extent over how good are we going to take care of customers, how are we going to invent new products and services, how are we going to get our revenues up, how are we going to grow shareholder value. That's all E. The P is price of what we're going to pay for those earnings over time, and that's what the Fed influences. Now, there's also a saying in economics that goes something like, don't fight the Fed. And what that means is when the Fed is adding liquidity to the system, we're printing new M2 into the system, don't be surprised if stocks continue to go up. And when M2 decreases, don't be surprised, don't fight the Fed. When M2 is decreasing or the Fed's getting tight with monetary supply, why? Because that's when asset prices adjust in the short run. That's why you saw that correction, that pullback in 2022. Now, it's also the reason why you didn't see this long-lasting pullback in 2025. Why? Because the Fed's been easier on monetary policy. They're actually easing conditions, and it's expected we're going to continue to ease conditions into next year. And it's also true that companies are producing profits at a record pace. So you almost have not this perfect environment, but you have a pretty good setup. I'm going to call it a pretty good setup, not a perfect setup for 2026, 27, and 28. As long as the Fed gives us a little bit of room to run and we're not fighting the Fed and they're not decreasing monetary supply and they're not increasing interest rates dramatically, and assuming that entrepreneurs continue to do their thing and they continue to produce profits and innovate, you have a pretty good setup for S&P returns to continue. Maybe not be 20%, 30% returns every year, but be pretty strong nonetheless. So that's been the long-term trajectory of the stock market since 1959. What I want to show you next is the 1970s. The 1970s are what a lot of people refer to today as saying we've never had this bad of inflation. If you go back to the 1970s, this is about as bad as it's gotten. Well, let's look at this. So Jimmy Carter was president from 1977 to 1981. And during his time in the Oval Office, M2 money supply growth was 8.6% annualized per year. So that was pretty high. It was not the highest we've ever had, but it was really high. And it was higher than the long-term average of about 6.7, 6.8, like I showed you on the previous slide. So we had higher than expected monetary growth in the 1970s. Now, inflation, this is a very unique time in U.S. history. actually increased higher than money supply. Remember, long-term inflation's been 3.7. It's been about half of what CPI growth has been. In the 1970s under Carter, it was actually worse than money supply. And so why is that? Well, it's not just because we were printing all this money. It was simply, in my opinion, because we had bad policy paired with bad inflationary numbers. So not only did we increase money supply and have a bunch of inflation from that, we also threw gas on the fire by not giving companies a great operating environment. And we increased taxes, we increased regulations. It wasn't until the Ronald Reagan years in 1981 that we finally started to cut regulation again. And I'm going to show you this in a second. That cut in regulation and cut in taxes that we did under President Reagan led to a lot of growth. Now, one thing before we skip ahead here that I want to show you is despite the 10.7% annual increase in inflation during Jimmy Carter's time in the Oval Office, you would have expected the S&P to completely fall apart and equities not to do well. That's just not the case. If you look at the Carter years, the S&P actually went up 9.4% annualized during those 4 years. Pretty good results. The long-term average on the S&P is 10, really not that bad, but on an after-inflation basis, people in equities lost money. People in almost every asset class lost money in the 70s on a real basis. But it's not like the bottom fell out, and it's not like S&P returns were down 50% or something. We just, after inflation, weren't up as much as we normally would be. We were actually down a little bit. So if you compare this to the Reagan years, we started to get companies working again. We started to deregulate a little bit, start to give some tax reform. And look at inflation here. Despite almost the same monetary growth as the Carter years under President Reagan, which I disagree with, I don't think we should print that much money, but we did. We only had a 4.5% annualized increase in inflation during the same time frame. And I attribute that to deregulation and tax reform. Look at the S&P during that 8-year period. And you could actually take this out under the Clinton years as well, another 8 years, because we had basically red presidents, we had blue presidents, throw Bush in there here and there. And a lot of them, despite the fact they were red or blue, a lot of them did the same thing when it came to monetary growth. They were still printing this 8% zone every single year. But what happened in the 80s was we finally made a stand once and for all. And we said we're going to have better business operating environment. And so that continued under the Bush family. It continued under Clinton. It's even continued now today, again, under the second presidency of President Trump 2.0, and it continued under Biden, that we just have not increased taxes that much. And we've kept regulation to a pretty good spot. It's not perfect, but regulation hasn't run out of control. You saw these crazy good growth numbers under President Reagan, 12.8% annualized in the 80s. And so I think the big question is, are we entering the 70s again, or is this really the 80s? Now, here's the numbers from before. Remember, 8.2% annualized M2 growth, 4.5% annualized inflation, 12.8% on the S&P. So the S&P after inflation produced incredible results. Look at 2017. And the reason I go back to 2017 is this is a few years before COVID. So you had some normalized environment to operate in from an economic standpoint before COVID hit. We printed 6.3% per year of M2, which is a little bit lower actually than the long-term average. We only had 3.7% inflation even after this massive jump in 2020, because the years leading up to 2020, we had very low inflation, about 1.8%. Look at the S&P now since 2017, has annualized 16.4%. So you ask yourself the question, if it's all because of the Fed, if it's just because the Fed prints money, that's the only reason that we get great returns, well, then how come it is that since 2017, we printed less money than we printed under Ronald Reagan, but we've gotten better returns in the stock market? Well, the answer is simply because technology has never been this good. Entrepreneurs have never invented this fast, and profits on the S&P because of all this innovation have never been higher. So it's not because of the Fed in the long run, it's because of entrepreneurs. And I think this is very important to understand, because as you get into next year, I believe the narrative is going to go something to the effect of the Fed is the only reason the market's up. And so that we're based on this Fugazi-Wazi economy. And I have adamantly disagreed with that for some time now. And I'm going to continue to disagree with that in 2026. So here's just a couple of easy examples, one of them being Microsoft. Microsoft's pre-tax profits in 2017 were 5.5 times lower than they are today. Microsoft is now doing 5.5 times more profit than they did in 2017, and their stock price is up about 7.8 times. So yes, PE on Microsoft has gone up, but it has not gone up to the pace that people think. In fact, the PE on Microsoft in 2017 was only 29. Today, it's 30.5. Not, in my opinion, radically overvalued. Same thing if you look at the rest of the S&P. The S&P in 2017 did 2.2 times less earnings. So it's 2.2 times more profitable today to be in the S&P. And its price is only up 3 times. So look at these PE ratios. In 2017, you bought the S&P for about 24 times earnings. Today, you're buying it, yes, a little bit more expensive, but not much, about 25 times earnings. Now, here's what's really interesting. The forward PE ratio on the general S&P 500 is actually 19 times. So what am I trying to tell you on this slide? What I'm trying to show you is that markets, the S&P 500 as a whole, is actually less pricey today. It's trading at a better value today than it did almost 10 years ago. And that's when the S&P traded about 2,200 points. Today it's trading 6,900. So even after going from 2,200 to almost 6,900 points over the past 9 years, or 9 years, the S&P is actually less expensive relatively today than it was back then. That's why I've told you to buy stocks and stay on your plan. Now, here's a couple of technology themes to watch next year, because this is what's going to drive long-term profit growth. Number one, a lot of people talk about AI. AI is obviously the big buzzword, but it's even more than that. It's just looking at autonomy. It's looking at number 3 there, high-speed computing. But autonomy is going to lead the pack. You are watching absolutely incredible results from Tesla, from full self-driving, some results coming in from Waymo, but Tesla is by far the leader. And it's going to change our economy fundamentally in a dramatic way. Autonomy is a big theme we're watching. Number 2 is cloud computing. You wouldn't believe how many companies today aren't even on the cloud. They're not even doing the basics. They still have people fill out paper forms, if you can believe that. And they're not even close to scratching the surface of what cloud computing can do. Number 3 is high-speed computing. That's really what AI is about. That's what NVIDIA is about, is just doing things faster with less resources. Absolutely incredible. Cybersecurity is a major theme, not going anywhere. And tokenization is taking a lot of these assets that are traded on the New York Stock Exchange, digitizing them on the blockchain, and then having instant settlement. It's going to do wonders for banking, the banking industry, for the financial services industry. So that's another big focus we have next year. But these are the key themes, I think, that are going to change the economy going forward, and that we're investing in the portfolio in 2025, and we certainly will be in 2026 as well. So let me give you my market outlook now for 2026. And to do that, I want to show you what we said for 2025, and then how the market reacted and how the rest of Wall Street reacted. On December 18th of 2024, we gave you a price target for the end of 2025 of 67.20 on the S&P 500. Almost all of Wall Street cut their estimates when we had Liberation Day back in April. You're going to remember this. Stenger Family Office did not. We said, stay on your plan. It's a little scary right now. We get that. But just stay on your plan. Don't worry. Don't get off your plan. We are not cutting our price target. Sure enough, today now, the S&P trades actually over our price target at almost 6,900, like I mentioned before, over what we said. All of these strategists who said that you should cut their targets, a lot of them went to sub 5,000, cost people literally billions of dollars of investment value by not keeping people on their plan. So what I want to show you now for 2026, and I mentioned this last week, this is the only thing that gives me a little bit of hesitation for the first quarter, maybe the first 2 quarters of next year, is the fact that now a lot of these bearish pundits on Wall Street are the most bullish they've ever been. And I'm not talking just a little bit more bullish. I'm talking a lot more bullish. In fact, Morgan Stanley came out and said their bull case, this isn't their base case, so I just want to make that clear, but their bull case for the S&P next year is 9,000 points. Now, if we hit 9,000 points next year, that is a bubble, absolutely. And we'll talk about what to do if we get to that point. But I do not think we are getting to 9,000 points next year. Instead, I think we're going to be somewhere in this range of what these other strategists have said. You have Oppenheimer here at the top at 8,100. You have Fundstrat, Goldman Sachs, JP Morgan, Stifel, and Bank of America. Fundstrat is Tom Lee's company, who we follow closely, who's coming to Investor Day. So all of these strategists, the setup for next year is basically the same setup we had for 2025. Be extra bullish, more bullish than you've been for a while. And I think we're going to have a shock to the system next year because we're going into a midterm election year. It would not be uncommon to see a 15, a 20% pullback next year. And it is going to shock the system. It is going to be a shock to all of us when our portfolio, let's say you have $1 million, goes down to 800 grand in the short term. So I am warning you today. I'm warning you right now, be prepared for a 15, 20% pullback next year. I think it's coming because, again, all the signs point to, Wall Street is bulled up and we're in a midterm election year, and that typically is a setup for a correction. Now, I think what they're going to do is they're all going to come out and cut their estimates and their forecasts like they always do. And because of that, I would expect there to be a lot of panic on Wall Street. I don't know when it's going to happen, but I would guess usually the first quarter, maybe the second quarter of the year. And people are going to have to digest a lot of bad news all at once. And it could be recessionary. It could be a variety of factors. But when it's all said and done, after these Wall Street pundits cut their targets again, just think back to 2025 and remember, they already did this playbook in 2025. So fool me once, shame on you. Fool me twice, shame on me. Don't get fooled twice here. Don't get fooled and buy into the negative narrative when they cut their estimates. Because what I'm going to show you here on the next screen is our target for the S&P. And who knows exactly when we hit it. I'm not sure. We don't have a crystal ball. But this is what the math of the market says. Remember, I go back to this simple equation. Earnings times price. What are companies making in profit? What are those profits worth in the future? And it's a simple equation to get the market level for what we think stocks are valued at or should be valued at. And what I say is for next year, we look into 2027 now. We go all the way to 2027 profits, and all the best strategists on Wall Street and the earnings analysts say about $351 is the number to expect for the S&P for a full year 2027. We are going to trade on that number at the end of next year, at the end of 26, like we always do. And I think we're going to trade the S&P for a reasonable 22 price to earnings ratio. That's going to put the S&P's level, in my opinion, at 77.22. Now, if you put the dividend on top of that, I believe we're looking at about 12 to 13% return in 2026 from where we're at today, which is, again, not out of the ordinary. It's not really that dramatic. It's not this big jump that would put us into bubble territory. But remember, I think we're going to get there, not before we have a larger correction. So stay on your plan next year. Be prepared for this. Just remember that we talked about this now. And remember, don't get fearful as we get into 2026, despite what the media tells you, despite what the doom and gloom headlines are, and all these annuity salesmen and people who come out of the woodwork every time there's a big correction, a big panic that happens, and tells you why this time is different. Just be careful before you buy into the doom and gloom narrative. So as you go and celebrate Christmas with your friends and family, I just want to wish you a very Merry Christmas. I hope you have a wonderful time. And if you can, read the Christmas story again with your family. And remember, do not be afraid. Thank you for being on for the last show of 2025. We'll see you again in the new year. Merry Christmas and Happy New Year.